The Empire State Manufacturing Index came out. It was a negative 9.1 year over year over the previous year. That's down from a negative 1.5 print, which means manufacturing is absolutely cratering here in the United States, especially that manufacturing as measured by the Empire State Manufacturing Index. It's a lot worse, almost twice as worse as what the experts had expected for the month.
Welcome to Gold Silver Pros.
Hey everyone, this is Rob Keynes from 𝙂𝙊𝙇𝘿. I'm recording this on October 21st, 2022, and you guys will see it Sunday night as the market opens. I'm back with a weekly market wrap-up where I look at the biggest economic events during the week. We take a look at the gold and silver markets, and we give you a little bit of preview of what we expect to see over the week ahead. We'll go ahead and just dive right into the economic calendar, as we always do, to start off these market wrap-ups. So as I mentioned last week, the biggest thing that I was looking at this week was going to be boots on the ground sort of intelligence and data points around manufacturing, around housing. And true to form, on Monday, the Empire State Manufacturing Index came out. It was a negative 9.1 year over year over the previous year. That's down from a negative 1.5 print, which means manufacturing is absolutely cratering here in the United States, especially that manufacturing as measured by the Empire State Manufacturing Index. It's a lot worse, almost twice as worse as what the experts had expected for the month. It just means that manufacturing is falling a little bit faster than what the market had expected. It is definitely not in a positive place for the United States right now. The Industrial Production Index, however, was up slightly at 0.4%. And I'm going to read to you the headlines there. It rose 0.4% in September. The Federal Reserve reported Tuesday. The gain was above economists' expectations of a 0.1% gain, according to a survey by the Wall Street Journal. Output in August was revised to a slight decline in 0.1% from the initial estimate. Capacity utilization rose 80.3%. So essentially, we are using some of our capacity, and there has been higher capacity utilization rates, but it's not on existing production. It's on previous production, and it's an inventory ramp, which I've been talking about. We've had a boomerang in the markets from when we restarted due to the COVID pandemics. We've now created too much stuff. People can't absorb that because of declining purchasing power, and therefore it's increasing the overall amount of inventory we have as measured by capacity utilization rate, not necessarily being reflected in current production and current sales. Also turning to home data, the NAHB Homebuilders Index was down to a 38. Last month it was a 46, and experts expected a 44, although it has fallen more than to be expected. Building permits held steady at 1.56. Although housing starts are down at 1.44 million, last month they were at 1.57 million. So both building permits and housing starts are down from last month, although building permits came in slightly higher than expectations of economists, while the housing starts came in lower. And I'm going to read to you why that is the case straight from the press releases. Here we go. Construction on new U.S. homes fell seasonably adjusted 8.1% in September to 1.44 million, the Commerce Department said Wednesday. The drop in construction on home reverses a sharp increase in August when housing starts rose 13.7%. Economists polled by the Wall Street Journal expected housing starts to fall to 1.47. On a year-on-year basis, housing starts are down 7.7% in September, which means dating back to last September, they're down 7.7%. Building permits for new homes rose 1.4% to 1.56 million. Economists had expected them to be 1.4 million. The big picture is the housing market is weakening rapidly, exacerbated by affordability concerns. Analysts are hoping that mortgage applications continue to fall last week, and mortgage rates continued to climb. Starts on new homes for houses fell 4.7% in September, while apartments fell 13.1%. So apparently what is happening is exactly what I said on the show last night. If you watched our Gold Silver Pros premiere last night, the name of that was Current Real Estate Collapse Predicting a Nasty U.S. Recession. We were talking about data from Case-Shiller and from the National Association of Realtors showing that the housing market is in a bit of a free fall. However, the markets today are doing quite well. At the time I'm reading this, at noon 15 on the 21st, the Dow Jones is up 1.73% at 30,859. The S&P 500 is up 1.51% to 3720.40. NASDAQ is up 1.28% to 10,751, and the Russell 2000 small cap is up 1.62% to 1732 on expectations that the Fed may have just said that they've been too aggressive on rate hikes and may slow those rate hikes down. Why would they do that? But you ought to know it could be the aforementioned real estate market, which is tanking, which is coming after the sell-off in the stock market and the rising interest rates on the bonds. So the entire market is now coming under pressure. The Fed has realized that, and they may start to slow down, although I don't think that they're going to stop their quantitative tightening program. Time of this report, gold is trading at $1651.92. It's up $25.06 or 1.54% so far on the day. We'll see where it closes on Friday. Silver is up $19.16. That's up 56 cents or up 2.97%. We're going to do a share screen and show you what's actually going on in the gold and silver markets, where the spot price is actually determined. We're here on the CME Group's website, where we're looking at volume and open interest for the gold market. As you can see, there was about an even amount of gold interest in the marketplace for the dominant December contract. At close, we had 363,302 contracts of 100-ounce gold trading, settling at, we'll get into settlement in a moment. We had 1609 exchange for physical, which is exchanging a contract on the COMEX for a contract on the London market, either to take advantage of differences in price or to take physical delivery of the metal. As we move over to settlements, we can see that yesterday we had on the December contract 164,354 contracts close at an average price of $1636.80, which was up $2.60. Going back to the previous day, Wednesday's day's trading, there was 179,910 contracts closed, having gold down $21.60 at an average of $1634.20. Moving over to silver, also reporting off the CME Group website, which runs those markets, a little bit slightly higher than average elevated volume in silver. Looking at the data for the December contract, as I've highlighted here, 110,644 contracts closed. And we see that 325 went to exchange for physical, meaning they were moved over to the London market from here. Looking at the settlement data yesterday, we had 58,505 contracts closed on the December contract at an average price of $18.68, causing silver to rise 33 cents. If we look back on Wednesday's data, different situation, but the same direction as gold, 36,787 silver contracts closing, down 24 cents average to a price of $18.35. That explains the movement in gold and silver. Now, as to why those price effects took place, we go to the Commitment of Traders report from cftc.gov as of October 11, 2022. It is backward looking over the data that actually created the prices on this market. That's why we look at the data and we look at the positioning by the big players in the market, and those are broken down to us by the CFTC as producer merchants. Those are actually producing the metal, the miners, or the merchants that are using it. You have a lot of short contracts there because they're covering downward price potential for silver, especially the producers, and that's typically the case. We have the swap dealers, also known as the bullion banks. It's the four big bullion banks in the market that we talk about all the time. They are net long silver, and they've been net long silver for the last couple of months. And net, they dropped slightly more short contracts than longs, but they're still at about the same position they were a week before. It's clear that the swap dealers, or the sharps as I call them, or the smart money, is expecting silver price to rise over the medium term. That's why they position themselves that way. The managed money made a big change. They dropped 4,300 long contracts and added 1,130 short contracts to silver, thereby almost moving to a net even position, as you can see here, 33,493 long to 33,378 short. They're relatively neutral positioned, and so they're not sure where the silver price is going to go. The other reportables, which are the wealthy individuals and family offices, dropped 3,798 short contracts and added 405 long for a net change of 4,100 to the long side. Clearly, the smart money and family offices on the market are expecting silver to rise. That's our expectation as well, on lack of physical availability, which we'll get to here in a moment. Looking at gold positioning on the COMEX exchange as reported by the CFTC. You can see here this table that we're looking at. Not a whole lot changed from what we saw before. Of course, there's more shorts in gold from the producer merchants protecting their downside price risk. They added 2,980 short contracts and subtracted 536 longs for a net move of 3,480 contracts of 120 ounces of gold to the short side. Obviously, the producers are expecting more downward pressure on the price of gold, and that's why the price of gold fell last week, was because they added more short contracts, which led us to a lower gold price, as you can see here in the data, making those connections for you so you understand how the market works. Looking at the sharps, or the smart money, the swap dealers, they dropped 3,300 longs in gold and added 357 shorts. They also expect gold price to see some weakness in the future. That's why the price moved down. Managed money dropped both long and shorts, but went slightly more long by dropping less long. So they're net exposed a little bit more long side. Still net short though, about 5,000 contracts. The smart individual money, the other reportables and the family offices are still net long on gold, expecting gold to go long in the future. They dropped 3,700 short contracts and added 1,000 longs to go net long about 4,800 more contracts. So clearly the big smart money is expecting gold to go up, whereas the swap dealers are expecting it to go down. Interesting developments in that market. Looking at the ETF side for silver, note that most of the silver for ETFs is stored in London, some of it in the US and other places. But by and large, this is a good read on how the London market is doing in terms of their silver stored. And we can see net over the last 4 weeks, down 21 million ounces of silver between the American and the London market. London overall has seen a net decline as well, although the SLV for the last 4 months is running positive. They're starting to see more silver come in. You can see that on the SLV chart right here. There's a little bit of an uptick in the amount of silver held in London for SLV, although overall for the ETFs in London, it has come down. And you can see the one big loss was out of ETF securities, PHAG, SFVRP, MAG, losing a lot of silver. Net overall silver coming down. And we'll see that on the London chart here in a moment. In fact, let's take a look at it. Here's the chart as of the 𝙆𝙄𝙀𝙉𝙀𝙗. And you can see that gold is slightly down, but silver is trending down very sharply in terms of ounces held in London. And that is because of these ETF numbers and the amount you see coming off there and this overall number here. That's how you tie those numbers together. Looking at gold, we've had a net 4-week move down 3.7 million ounces. We see the COMEX net is down, although there was some positive movement of 65,000 ounces into eligible. There was a decrease of 1,100,000, 43.795 ounces out of registered in COMEX, and that is the liquid tradable gold, which means gold is coming out of the COMEX in terms of what can be delivered on contracts. And total, a net decrease of just over 1 million ounces on COMEX the last month. And you can see the ETFs are bleeding out of London a lot of gold as well. And you can say that in the chart, this is where that gold's coming off very slowly. A lot more gold held in London than silver, respective to what's being taken off of the exchange. So again, expect to see a shortage in silver around the world much faster than we see a shortage of gold. And so I think that's going to change the narrative to where we see silver spike before we see gold spike this time. That will be a change from the past, and it's due to industrial and retail demand in the physical. It's not manifesting yet in prices right now because the derivative markets aren't aware of it. When that news hits the derivative traders, they will flip long in silver, and that will cause a nice pop. And I think that will cause people to start paying attention to gold, platinum, and palladium at that time as well. And we'll see what happens to those markets. Looking here at gold price in Chinese renminbi, I wanted to point out, if you go back and look to a gold and silver chart, gold for the last 30 days, if you count its high during the month, is down 4%. Silver is down 6%. In the American market, if we look at gold in the Shanghai, it's only down 2% from its high on October 3rd. Note that gold peaked on October 3rd in both the Western and the Chinese markets, but that China fell less because it's a more robust positive market for gold price. And that's why gold in China is priced higher when you do the conversion to US dollars than it is in the Western markets. Those Chinese markets are more delivery, as we're going to show you by the data. We simply go to the Shanghai Gold Exchange and pull their monthly report, and you can see how much the trade is in terms of a percentage of the overall. So if you look at gold, look at the delivery volume of contracts, 721,876, trading volume of 931. So about 77% of the gold contracts in the Shanghai market are delivered in physical, 77.52%. It gets nowhere near that in the deliveries on this market. If we look at the deliveries for any given day on the market on the gold chart here for the US, you see 175 deliveries out of 363,000 contracts. That's not even a percent. It's not even a half of a percent. And then we change the days, go to Thursday. You look at delivery 16 off of trade of 365,000. If you go to deliveries for Tuesday, you see deliveries of 54 divided by 46,335 contracts. That is a minuscule amount when compared with delivery in the Shanghai. The Shanghai is considered much more of a delivery market. much closer to the actual physical gold price, and that's why gold prices are higher on the Shanghai. If you look at silver, 18.79% deliveries, that's still much higher than it is on the COMEX. If we look at the COMEX, for example, we're looking at Thursday's data, 3 deliveries out of 110,000 contracts, not even maybe 0.1%. On Wednesday, 0 deliveries, 110,000 contracts. You can see the data there. Tuesday, 2 deliveries on 109,000 contracts. Different situation in the Shanghai, much higher deliveries. Therefore, I think it's a much better price market in terms of physical, as delivery ratio is much higher. Now, how did the Shanghai do in terms of actual gold? It's actually down slightly. Here are the different batch of products that they sell. I won't get into that. This is in kilograms and this is in renminbi, but I wanted to show you the change from previous month. So down the previous month, 19.03%. If you look at the bottom of this table, this column, month to month, the gold deliveries are down 19% on the Shanghai, which just means that there are less contracts, 19% in September than they were in the previous month in August. Not a big deal there in terms of the overall amount. In terms of renminbi dollar amount, it's only 12.63% down. Why? Because the renminbi has strengthened relative to the gold price. So even though the actual physical is down 19%, the in renminbi, it's only down 12.63. That is going to be your market report for today. I'm going to give a real quick preview over the economic data points that we're going to be looking at next week. Next week, we're going to look at the Chicago Fed National Activity Index, the U.S. manufacturing PMI put out by the S&P, the services PMI put out by the S&P. That will tell us how much we're growing or not growing leading into the next GDP print. We're going to look back at Case-Shiller Home Price Index, which we spent a lot of time looking at yesterday, Consumer Confidence Index, real gross domestic products, initial and continuing jobless claims, durable goods orders, and the core price indexes, which will be out next month. We think those are going to be very important data points for you to follow. This is going to do it for our weekly market wrap up. If you're on the Gold Silver channel, Gold Silver Pros channel, stay tuned for Ian giving us his metal market update.
Searching for the best precious metals deal? Shop with our trusted partner, 𝙂𝙃. Access special deals on silver, gold, and platinum through our website, or call 307-264-9441.
Hey everybody, I'm joined by Ian Everard to give us this week's metal update and also his opinion on what's going on in the markets. Ian, how are you doing today?
I'm good, thanks, Rob. And yourself?
I am doing very well. I know that you are freshly back from your trip down to New Orleans for the New Orleans Investment Conference. Before we get started on the metals report, how was that, Ian?
It was a great conference. Yeah, met a lot of people, talked to a lot of people. So that was good. Talked to some of the other dealers, some of the miners, some of the real estate guys. Yeah, interesting being an exhibitor compared to being an attendee.
That's right. So being an exhibitor, I'm sure you see a lot of people walking around. What was the general sentiment of people there? Did it seem like they were very positive? Or, you know, what was the mood and discussion there in New Orleans?
Oh, the general mood. I didn't really get to gauge that, not sitting in the talks. If I was sensing it, I would say cautious.
Yeah, that makes sense.
Yeah, that would be probably. Yeah,
a lot of uncertainty going on in the market, so it makes sense that, you know, at that conference, that would be the mood, and that doesn't surprise me at all.
Yeah.
So you know, the last couple of weeks, you and I have been talking about the physical markets. We know, you know, on the COMEX, the spot price doesn't tell us what's going on in physical, so we'd like to have you on to explain what you're seeing, you know, as a dealer. So what are you seeing out there, Ian?
Yeah, everything is in tight supply. You can't guarantee you're going to get 1,000-ounce bars quickly or live. They used to have choice of, I don't know, between 100 and 300 bars from a range of wholesalers. I've heard from other dealers over on the East Coast, missed deliveries. I mean, yes, that can happen. I've heard from a major New York wholesaler, and his words were, the mints are taking delivery off the COMEX and it's never going back on. And his concern is that the supply of silver to the mints is in short supply, which would suggest that they're not able to buy it straight from the refiners. That would be the usual lowest cost route, because standing for delivery for a contract has time delay and extra costs and possibly uncertainty.
Yeah, the COMEX, I mean, I think Rafi's video illustrated that, yes, you can get it off. It's difficult, though. You have to go through a certain amount of brokers. It's not definitely not something that occurs on an everyday basis for retail. But it's interesting that you noted that the retail mints and shops are now starting to go to COMEX to get it directly because, and what we've been talking about, what goes to the refiners is what comes from the miners. And for the fourth year in a row, we've had a deficit in terms of what the miners are producing and what the world is demanding, both industrially and for investment purposes. So now, if we're not getting it from the refiners, that means people are raiding stockpiles. And what are the stockpiles? We got SLV, you've got COMEX, you've got London, and those are the three big ones. Is maybe a few other places you can get it. It doesn't surprise me at all. We've seen that silver come off of the major exchanges, and it's interesting, as to who's doing it. I would have thought originally, Ian, it was a lot of industrial users trying to get it because they're the ones that really play around in that market. But I guess it doesn't surprise me too much that the retail end is starting to look for it there as well.
Yes, I mean, obviously the mints are taking the bars to make retail products.
Mm-hmm.
And you probably remember well last year, the Silver Symposium, what happened when I asked Mr. Jeffrey Christian why the refiners are buying their own 1,000-ounce bars off the market and reselling them.
Mm-hmm.
My theory or hypothesis then was there must be a shortage of silver going into the refiners.
Mm-hmm.
And you probably well remember his reaction was to cast aspersions, try and bring disrepute to the source I quoted, and then it resulted in him insulting you. So
well, it seemed awfully predictive because what you mentioned to me last year seems to be coming true. Just like you said, now they're going to the COMEX because the refiners don't have it. Maybe this is last stage before we actually physically run out of silver, because if there are not enough coming from the mines, and it takes years to get new mines on, especially primary silver mines, and we expect there to be a crash maybe in terms of demand for overall commodities as we enter the economic downturn, which means the 72% of silver that comes from as a secondary byproduct of all these other mines will probably fall. Doesn't it seem like all of those factors are setting up for a big silver shortage here in the next few years?
It could be in the next few months, if not sooner. If you think about it, the people in the system will front run.
Mm-hmm.
If they see an acceleration of the decline on the COMEX, and I think there's roughly $700 million at current spot left on the COMEX.
Mm-hmm.
So that means every American has to buy $2 worth of silver, and that's the COMEX emptied.
And that's it.
That's gone.
They can't even get an ounce. You can get 1/8 or 1/10 of an ounce.
Well, yeah, less than a tenth. Yeah.
Mm-hmm.
So when you look at it that way, it's incredibly rare.
Yeah. So if you're in America and you want silver, as I've been saying now for probably a year, a broken record, now's the time to do it, because we saw this coming. We saw it, we saw it before silver squeeze, but really a couple of years ago, but silver squeeze really emphasized the point. We knew people were going to go after physical. People hit that ETF and realized there's no redemption. They thought, maybe I need to get it. And ever since then, they had just been pulling silver right and left. And yeah, it makes total sense there. What about gold, Ian? Is the same thing happening in gold, or is that a little bit of a different story for the yellow metal?
I generally deal in gold kilos. I do 1 ounce coins and some fractional, but generally my largest market is in kilos of gold, and now they're up to 2 weeks out. And that's from a major European refiner. So that would suggest to me the demand is exceeding their flow.
Yep.
Production flow.
Well, I think there's an arbitrage between gold and silver right now, given the particular dynamics of silver. And I think this time will be a little bit different for silver. If you graph it over time, typically gold price rises before silver. That's when both were relatively abundant. Given that silver is used up so much industrially, and we start to see the big demand coming in for investment, I think silver will pop first. So one of the things that I did recently is reached out to you and said, hey, I've got some of this gold. How about I trade for silver? And I think, Ian, that may become a popular trade here going forward. What are your thoughts?
Yeah, if your time scale isn't too short, these ratios in the 80s and 90s gold to silver ratio, That will, in my opinion, correct. And when it corrects, it will be a rapid correction. And silver doesn't even have to lead gold this time, because gold has touched or exceeded its all-time dollar high around $20,070. Silver didn't get anywhere near its all-time high. So gold has led. So it might appear that silver is going to break away, but it'd only be catching up to where gold has moved. So yeah, I think there's every chance that silver could run away and then gold will follow.
Yeah, I agree with you there. So Ian, what about the economy? Thanks for the metals report. What do you see in the economy that leads you to believe that, we should continue to have a bull market in gold, silver? Because there's a lot, there's a lot of I think just general, people are trying to figure it out. The gold and silver prices haven't moved yet. We know the physical is moving, and the prices will come later, once the derivative markets figure it out, and those, they haven't figured it out yet. But what, fundamentally is driving a long-term bull market for gold and silver in your eyes?
Oh my gosh, I think that's too big a question for a short update. But just the Credit Suisse problems,
Yeah.
Deutsche Bank, Commerzbank, Societe Generale, all the European banks, they're in a whole world of trouble. I mean, Deutsche Bank had a 4.7% buffer for loans to go bad. Now Germany is going to be on short electricity over the winter.
Yeah, that's a really good point. It could be a really bad issue with them not having cheap electricity that could affect Germany's overall manufacturing. And if it does, it's going to affect the ability of people to repay their loans. It's going to affect the ability of businesses as well. And so that's probably going to turn out to be very negative for them.
Yeah, so in general, yeah, it looks like it's going to be Europe going to lead the financial collapse, but Japan might beat Europe to it. And it seems to be a plan of the Federal Reserve to keep on raising rates to wipe out the rest of the world's banking systems. It would seem like the globalist financial network is fighting amongst itself, and the Federal Reserve has all the power there at the moment. If they keep raising rates, capital will flee to where it's least worst treated, which will be here, and liquidity will just evaporate in Europe. I remember looking over a year ago, Deutsche Bank had a 4.7% capacity for loans to go bad. Now it's got maybe a 3-day week for German industry. So they can get more than that in loan failures. So that will bring Deutsche Bank down, Commerzbank, and who knows how that interconnection will work. I don't think even the banks know how deep the interconnection is. And they seem to swap debts for debts and net it off as zeros and liabilities for liabilities. And suddenly nobody owes anything. And suddenly one bank creates $1 billion, another bank creates $1 billion, and they both have $1 billion each because they lend it to each other. It's hard to get your head around, but that collapses very, very rapidly.
It's an incestuous system in which they issue debt out of thin air, which creates currency at the same time, and how this works. That, however, worsens the balance sheets of everybody involved because debt is debt. It's a repayment. You owe something plus you're paying interest. And they first in Europe tried to solve that by doing negative interest rates, but you can see people aren't buying that. They're not stupid. Why would I want to pay money to hand you my money, pay you a rate of return, and going into an insolvent economic system for you to hold that and use my money chasing return on when everything's crashing? So they're not going to be able to get their return back to pay me. So not only am I going to be out my principal, I'm out the money I paid you on a negative interest rate system to basically screw everything up. And when all of that stuff hits the banking balance sheets, the whole thing's just going to go. And what we were talking about in previous videos with Exeter's pyramid, that it's going to be a sucking sound. It's like flushing the toilet. All the money goes from all the junk at the top all the way down to the base, but sitting at the base is gold and silver typically.
Definitely. Definitely, yeah, primary wealth. And again, if we look at the Australian Central Bank, the deputy had the nerve to say, yes, we're insolvent, but it doesn't matter because we create money. It's like, I think they actually believe they can do what Japan has got away with until now. Just keep creating money. But Japan had the benefit that they were productive and they had a trade surplus. So they've got away with it a lot longer. But the yen is down, what, 30% this year? I mean, I wish I'd known how to play the currencies. I mean, heck, I should have learned that at school.
Yeah.
You see that, 30% is when the pound going up and down in about a 10% band.
Yeah.
There must be a lot of rich currency traders out there.
Yeah, and to add to your point, why Japan survives, because the rest of the world could support them. They could buy their debt or whatever the case may be. They could absorb the issues that Japan was having, and because Japan is such a strong industrial nation, they still had the ability to manufacture. And I think more than anything, Ian, it was that manufacturing which kind of held them up. But
absolutely. Yeah.
But now we're seeing such high debt levels. Look at Rogoff and Reinhardt's report from Harvard 10 years ago. They're way past 90% of GDP. So they're gotten to the point where there's so much debt that even their ability to manufacture is not going to save them in this crisis. And the rest of the world, Ian, can't save them either. So maybe Japan or Europe are the black swan, not just the banking system, but the sovereign issues could be the black swan that takes down the rest of the world as well, couldn't it?
Well, yeah, I mean, Japan, I think, has 100 billion dollars left in cash reserves, and then it's into its 1.4 trillion of US government debt.
Yeah.
But all that will do, if it starts selling that will drive their currency lower. So it looks like for now, the Federal Reserve is going to win this fight against the rest of the world. But I think the gloves are off, and there's going to be no limit to the rounds they go. So if you think of a boxing match, 12 rounds or whatever, think of a boxing match of 100 rounds and no referee, no rules, and the Fed has got the biggest gloves and the biggest boxer in the ring.
And they probably paid off the ref and all the announcers, and
they
paid off everybody in the crowd.
Yeah, they can keep raising rates. They could slap a 1% rise in for fun, just for giggles.
Why not?
And they don't care, because they know if they're going to do it, they know they're going to do it, and they've prepared ahead to benefit from the results. So, yeah, I'm still in a position they're not going to pivot till at least 8%.
Yeah, I think you're probably correct there. I never believed they could pivot, because what's the point of pivoting if the problems that they're trying to solve with raising rates and they don't get anywhere near the inflation rate? They can't pivot, because all they're going to do is make the crash worse that they're trying to avoid. So I agree with you. I think they have to at least get to around 10% to combat inflation. And I don't know if they're going to get there before they crash the domestic bond market, because now you're talking about huge coupon payments for bonds that they keep issuing. So if we were in a state at which we were retracting all the bonds and raising interest rates and we had the money to do it, we'd be okay. But none of those factors is true. Issuing more bonds, rates are going up, not a manufacturing nation, so we can create our own wealth from the inside. Big problems, it seems like, for the US going forward. And all right, I think that's going to wrap it up today for our market report. Thank you for giving the metals report and talking about the economy. Ian, how do people contact you if they're interested in ordering the precious metals?
Yeah, we are 𝙂𝙊𝙇𝘍.com, or you can go through on Rob's channel. You can go through the link there. Yeah, give me a call or a text. That is the quickest way of getting hold of me at the moment. Emails, we are on a backlog of about 2 to 3 days now. We've got so many inquiries, and we're dealing with existing clients all the time as well, who are repeat buying.
Yeah, that's good to know. So much buying that it's hard for you to keep up, and those are good growing pains to have. If they want to access your services or our website, they just click here on Precious Metals Deals. Takes them down to this web form. They click on Access Deals. Fill out this form, and we'll either text you back or email you from here. So whitelist your email and your phone number so he can get back in touch with you. And thank you, Ian, so much for stopping by the program. This is going to do it for today. We'll have you back on next week.
You're welcome, Rob. Oh, and by the way, we have plenty of live stock. We placed the biggest order we ever did by far 4 weeks ago, before the premiums blew out. So we have enough inventory so we can sell from live stock, and then we replace, and we're the ones that waiting for the metal, and hopefully not you, the clients.
Good to know. Okay, thank you so much, Ian.
Thank you, Rob.